Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland with my co-host JP Hampstead. So we've just gone through Thanksgiving week, and you know, this is peak retail season, a lot of increased activity. And what are we seeing in the market right now, JP?
Well, we're seeing that capacity, especially in kind of certain upper Midwest and Rust Belt markets, is pretty tight, which is driving the national outbound tender rejection index up to what's like just above 7.9%, nearly 8%. It had kind of moderated a little bit earlier this week, but it's bounced back, so that's kind of interesting. Kind of tells me that drivers have been slow returning to the highways. They may be avoiding certain markets for weather reasons and things like that. I think that's probably one of our kind of key indicators as to how transportation companies will perform in the peak season.
Yeah, so another interesting fact, we monitored the lead times. So tender lead times before the holiday actually increased significantly. So that meant that a lot of these load orders we were seeing were happening this week. So what that did was basically create a buckle in the load order column. So they were rejecting them before the break, and then all of a sudden they're still available after the break. So now you have this double up effect, almost like two waves hitting each other. So that's going to tighten capacity further than it probably was anticipated.
That's interesting.
Yeah.
I know that I think I was talking to some brokerage executives this week and last week just about how they're getting ready, conversations with their customers both around peak season but also around bid season. I was talking to Bobby Harris, the CEO of Bluegrass Logistics, yesterday actually, and he just said that things are firming up. He said that from his perspective, they like to solve hard problems for their customers, would like to see capacity tighten up even more for their business.
For sure.
But I think we're in a good place. I mean, we're still, volumes aren't there yet.
They're not quite as robust. We're still operating in that 1 to 2% above 2018, but it's not making a definitive move higher or lower right now.
And I think if you go back and you look at the 2018 data, like what you see is that any kind of essentially it falls steadily through the month of December.
Right.
Fewer and fewer shippers try to get stuff done in that month if they don't need to, because they know how capacity is being allocated. Any kind of tightness in the markets is going to be driven by the supply side, not the demand side, in our view. And so we'll see how that plays out. I mean, we know that there was that protracted, sort of weird, artificially tight period after road check in June. We've been monitoring the situation to see if that happens after Thanksgiving. So far, it looks like we might be kind of in that situation.
Yeah, no, the things have tightened up. I don't know if I'd call it artificial whenever we go into something it's either tight or it isn't. But I see what you're saying in terms of demand side tightness. It's not necessarily driven by increasing amounts of volume.
It's supply side tightness, and it's temporary in relation to the holidays. Kind of why I mean it's artificial.
Because drivers are out there, they're off the road, doing something else. But another thing that we notice this time of year is a lot of regional demand spikes. So that presents a problem. The market isn't evenly distributed with trucks all the time.
Correct.
You can have the market being generally soft while, you'll have a big spike of produce, for instance, out in California, and all the trucks aren't there yet. And speaking of LA, we've noticed some interesting developments with LA recently.
Yeah, so Henry Byers, our ocean market expert, wrote this morning in the Daily Watch just about this sort of collapse in import shipments into the port of Los Angeles and kind of the knock-on effect that we can expect in trucking, which kind of fell apart sort of last month in November, and it's a situation that I think transportation companies need to be aware of, because for most of 2019 we were below 2018 at volume levels. LA had been a consistent and reliable source of freight. The problem was that the market knew that, and consequently it was consistently oversupplied with freight, extremely low tender rejection numbers, not much pricing power on the carrier side. Now I think we can say that conditions have deteriorated from there, where the market is underperforming on the demand side as well.
Right. So, with all the freight pull forward, the trade war, all the concern there, you had a lot of increasing imports. We monitor this and Sonar, where we do see a lot of retail shipments coming in, because that's a lot of the pull forward demand was on the retail sector.
Right.
And so this was, anomalously high. It was actually bigger in January, February, import shipments, than peak season, which was August, traditionally in August and September. So we're starting to see that deteriorate, and again, we've noticed a lot of things that just basically fell off a cliff in November. Rail volumes, intermodal volumes, as well as imports into LA. But we're seeing that, kind of a balanced shift across the country as well, correct?
Yeah, so when we were talking about this just before we started recording, if you look at like loaded 53s on intermodal going from LA to Chicago, it looks like it was growing for a while, like kind of the past 3 to 6 months. But then when you look at like the 40s going on the same lane, they've like fallen off sharply. So it's kind of a shift of equipment, not necessarily a growth in volume. But what we have noticed, and Zach, what you were saying earlier, is that one of the interesting leading indicators that I think is probably understudied as far as our data sets go is the movement of empty containers.
Right.
Because the movement of empty containers is interesting because it's not driven by customer needs or shipper needs, right? It's not Myers or whoever, or Dole Foods moving freight, from a port to the interior of the country to where it needs, to a particular intermodal terminal where it can be drayed. These are the shipping companies, the container lines, anticipating future need, and therefore repositioning their empty assets in anticipation. And what you're saying is that they're essentially getting pulled from the West Coast to the East Coast.
Yeah.
Why is that?
So effectively, they're seeing something overseas that we don't see yet. And over time, of course, they notice they have access to who all the original shippers are. So effectively, they know basically where the demand is going to occur over the next couple of weeks for sure. But this shift of empty container volumes is kind of a signal to watch. We're already seeing it in domestic truckload volumes. The outbound volume index for the Elizabeth, New Jersey market, for instance, has been outperforming since about May or June, about 30 to 40% up year over year.
So it's a proxy for the ports of New Jersey and New York.
Correct. That's exactly where the port of New Jersey and New York is. Because we've seen elevated East Coast volumes all year, but it's especially important this time of year because that's where all the population centers are. You're sitting around the megalopolis. We're seeing, people don't have time to ship into LA anymore. We've also seen a slight shift to Southern Asia as shippers resource their freight movements down there, trying to avoid some tariffs. But Elizabeth, New Jersey, right in the middle of all of the population across the country. So.
And I think there are other ways that increasing activity in population-dense areas, especially around e-commerce, plays out in transportation data and plays out, frankly, for the profitability of transportation companies. And I'm talking about the average length of haul.
Right.
Now, that declines sharply every December. Really, in November and December, bottoming in December before moving back up. Can you talk a little bit about what average length of haul is, what it means, and then maybe we can get into some of the segments and talk about why demand for transportation is taking a different shape going into the holidays.
Yeah, that's as a former pricing analyst, the minimum shipments, they're a big game to play. It's very tough to manage minimum shipments. So when I say minimum shipments, I mean anything that basically this is going to be the lowest price that we offer the shippers. When you're moving below 200 miles or so on average, which is the sector that we're talking about, that shorter length of haul, when that type of freight increases. So for a truck driver, they basically can drive between 400 to 600 miles a day on average. So anything in that range means that they're fully utilized for that day. You get below that, now you're getting into the day and a half movements, or maybe they don't have quite as much time to go pick out multiple loads as they need to. So these shorter length of hauls can really be disruptive to trucking networks. So that means that shippers also need to be cognizant about how their prices are adjusted, but also truckload carriers need to be cognizant of how they're pricing their freight now. Simply charging, the rate per mile becomes irrelevant at this point. That means they're going to see a lot more $600-700 minimum shipment truckload moves in that area, in that region, because you're going to see a lot more DCs positioned closer to population centers, closer to retail hubs. And that's going to be a change of dynamic. You're going to have regional carriers seeing a lot more activity, whereas your over-the-road guys are going to start to see slightly less volumes on their end. And
to your point about increasing activity in those sort of minimums or minimum loads, however you want to call it, there's some, to zero in on the e-commerce impact, there was some discussion on some driver Facebook forums about the Amazon relay load boards and basically how they've just been popping off, and that throughout most of 2019 Amazon had been posted, there have been about 2,000 loads available every day on those boards. Now it's up around 4,000, and so they're really searching for that kind of a lot of them are power only, but it's just getting these trailer moves and just increasing that cadence of those little shuttle runs.
Yeah, and to your point, I mean, Amazon's really driving a lot of this, need, this demand in the marketplaces. Other retailers out there start shifting their supply chains and changing the way that they operate. One thing that I read was that, actually analysts are lowering their guidance for Amazon into the first half of Q1 due to this investment process. So all these carriers are coming in, on these load boards. They may be willing to operate at a loss on some of these shipments because they're really pressing this one-day shipment. I know I love my Amazon Prime, getting it there next day, but there's an increasing cost burden there as well, especially if carriers notice that they can only haul like one, especially around the megalopolis where traffic is so heavy. You got a lot of tolls. It's going to take you a lot. Maybe you can only get 250 miles in a day out there. So that's your full day, making a delivery from the port to a DC.
And we talked about this, I heard about this last year for the first time, and we talked about it, and I think it's true even more this year, that things like Amazon Prime and same-day delivery that are, and same-day is widely available in the East Coast megalopolis, actually changes consumer behavior in peak retail season, where you see more cycles of order, return, order, return, order, return, as people, and that's how people are shopping now.
Right.
That I think drives the intensity for transportation demand, and I just think that in general, the way that the holiday retail sort of industry is evolving, with overall holiday retail sales projected to grow between 3.8 and 4.2% this year, year over year. E-commerce's share of that, e-commerce growth is supposed to be about 14 to 16%. So it's literally transforming. It's growing faster, taking more share, and causing an overall evolution in the way that retailers get their goods to consumers and the way that those goods have to be moved.
Yeah, so I guess on that same note, we're seeing a lot more tightness in the northeastern corridor, correct? Yeah, I guess let's run down and see what what's going on in the overall market. Like, where are we seeing pockets of tightness across the country? Because we are hitting that peak retail time of year. Elizabeth, New Jersey, that area, Harrisburg, Pennsylvania, a lot of shorter haul loads available right now around that market. Increasing tender rejection rates, of course, pulling rate pressures up. But are there other sections of the country right now that we're watching?
I think places like Harrisburg, we talked a little bit about Michigan and just the resumption of General Motors' sort of entire business, leading to a surge in volumes and therefore a surge in rejections, both in Detroit, Toledo, and Grand Rapids, correct?
All the auto parts distributors, suppliers right there.
Right.
General Motors is trying to get back up to speed. A lot of lost production in a month.
That's going to be interesting. I think that's going to actually, the effects from that strike will persist for a while. That's kind of where we're at now. I mean, rates are up. I don't think this is the beginning of a cyclical turn. I think it's very seasonal. To look out further, Actually, interestingly, this week Goldman Sachs reinitiated coverage of a bunch of truckload and LTL carriers, and they're and based on net Class 8 truck orders going sort of below replacement levels for a long period of time. They predict a turn in the capacity cycle in Q3. As we know, the Coyote curve is calling for it in Q1.
Right.
I think general freight broker sentiment is the consensus is around Q2, which actually makes sense.
Well, that's seasonality comes into play there for Q2, and
Right.
you know, you obviously nobody's going to call for a recovery. I don't want to say nobody because Coyote called for a recovery in Q1. I don't think a lot of our data points to, you know, probably actually a much worse Q1 than last year because we are seeing a lot of the retail sector pull forward effect is now diminished.
Yeah.
The things that were propping up volumes on the West Coast early part of this year, that's all going away and rapidly. So, but we are seeing, I guess, December 15th, we're about to see some sort of answer. Are we getting any more news on the tariff situation?
Yeah, so that's the deadline for some consumer electronics tariffs. Sort of, and once that's imposed, pretty much all of our trade with China will be tariffed. Although that's, you know, I think that's being kind of counterbalanced in the equities markets by an increasing recognition that Trump does want to get to a deal, that he may be under some election year pressure. You know, we had really great jobs numbers come out this morning.
Yep.
Huge beat on jobs, exceeded job growth exceeded expectation by, I want to say, something like 80,000, something like that. Jobs.
Now, our lead economist is actually a little concerned about those jobs too, because we were talking the other day about this, and how a lot of these jobs are actually, you know, low-income jobs, and they're not going to be enough to, you know, as these tariffs and other things occur, you're going to see the cost of these goods go up. These low-income jobs may not be able to keep up with the affordability.
Interesting, yeah. That's something to keep in mind. I wonder, you know, I really do wonder about GDP in the first quarter, but I don't know. I mean, it's hard to tell. We're still, you know, above 2% growth. I don't, you know, there's no larger recession, and it seems like so far, from what we can see in our data, that the consumer has delivered.
Yep. I guess that is good news in the way that we are seeing this real booming, whether it's at a brick and mortar store or not. We're seeing this booming retail cycle right now that's really going to have a lasting effect into the first half of next year, but I still don't see it being enough to really overcome all the other activity. Election year, as you mentioned, that's going to be a big factor.
Election year is typically bearish for capex.
Yep.
Right?
Yep.
Essentially, large companies are reluctant to commit to big investments and projects when there's any kind of policy uncertainty.
Right.
And they don't know what their tax situation is going to be, when they don't know, you know, well, yeah. I mean, the difference between, you know, a President Warren and a President Trump could be profound. Although I do sense that there is a lot of pent-up demand for capital expenditure in corporate America, because so much of it's been delayed by tariff uncertainty, policy uncertainty. So, you know, we'll have to see how that goes. I think that if a couple different things go right, 2020 could be a pretty good year.
Yeah, I don't disagree. I think it's still going to be in the second half of next year before we see any significant shift in dynamic. Again, election year creates all sorts of questions, but we did have our last big expenditure was in end of 2018. So that means that companies have basically sat on money for a year, good or bad. So that means that, like you said, there will be pent up. So I wanted to mention, you know, it is Christmas season. You did have an interesting,
a lot like Christmas.
You know, you're head of Passport Research now,
yeah,
and you did write some interesting stuff. I want you to cover that real fast. The Pacific Northwest. I want to hear about the apples and the trees.
Oh yeah, so obviously Christmas trees. Is that, you know, the interesting thing about Christmas trees is that they are sourced from a lot of different regions in the United States, including, you know, Maine, including Georgia, including North Carolina, the Pacific Northwest. But of course, the Pacific Northwest is really, it's their moment to shine during Christmas tree season. That's been interesting. The other thing too, though, is that this new Cosmic Crisp apple that's come out in Washington State, right? That's driving a little bit of tightness in refrigerator equipment coming out of Spokane, Washington market. This Cosmic Crisp is being pushed by apple growers. It's really popular. It's supposed to be one of the best. It's supposed to become one of the best-selling apple varieties in the United States over the next couple years. That's something to watch because its peak harvest season overlaps with Red Delicious, which is kind of grown more in the Midwest, in like your Iowa, Nebraska, Indiana, Illinois area. And so we see, if you haul apples, if you haul produce, if you use refrigerated equipment to move agricultural products, we might end up seeing play out over the next couple harvests the situation where we've got a double apple season occurring in two different regions.
A double up effect.
That could kind of stretch some capacity in some interesting ways.
Yeah, the Northwest has been pretty active this fall, but we're running up on time, so we'll go ahead and close this week out. And again, thanks JP for all the insight. You can any Sonar subscribers actually can check out a lot of this research in detail.
Yep, it's all in Sonar. Click on the light bulb icon on the upper right of your screen and get into the research, and you'll see all of our reports. We're covering trucking and intermodal, separate weekly reports. We do a special topic each week, and eventually we're going to launch ocean coverage as well. So stay tuned for that. Really excited about that, and of course, plenty of other great research in Sonar as well.
All right, well, that'll do it for this week. Thanks for watching. Make sure to follow us on all our social media, as well as check out our new FreightWaves Live app.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the freight tech revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.